Let's go to what history tells us. When the Fed raises interest rates or changes its cycle from lowering or benign monetary policy to tightening, what typically happens?
Well, hey, Tyler, thanks for having me.
Sure.
So there's two outcomes when you look historically of what happens after the Fed stops tightening. You're either going into a recession thereafter or you're not. And the bullish narrative today is almost that we're not going to go into this deep recession, or we make it not go into recession at all, and that we've found the bottom in the market, and we're just going to keep going up, 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 and up from here.
You believe that? You buy that?
No, and but it has happened 4 times. So if we look at those 4 times that's happened, and it happened most recently in 2019, before that, 1995, 1985, and 1966. And so in those examples, the Fed did tighten. We did not go into recession thereafter. And what happened at the bottom of the market when the Fed stopped in each one of those 4 times was a V-bottom recovery in housing data. Each one of those 4 times. And that's one of the many reasons we don't think that that's a good parallel for today's market backdrop, is we don't expect any kind of recovery in housing anytime soon. And we do also expect to go into recession.
And I guess to Steve Leisman's point, yes, we can look at history as a guide, but things are very different now. We're just coming out of a global pandemic, the likes of which none of us have ever seen before. And we have this unemployment picture that looks relatively strong, as Steve says, to try to get us back up to where we were. So why then are claims so important for you going forward rather than inflation, when that seems like that's the big worry that everyone is trying to tackle?
Yeah, well, right now, this year, inflation has been the number one issue, and it still is today. And that's why we've seen the market rally in the last 5 or 6 weeks since the middle of June. As inflation data, oil prices, high frequency inflation data like the prices paid index, we just saw came down to 60, which is the best reading in the ISM this recovery. And so I think, the market has already priced in that inflation's coming down. Again, that's why the market is up today or in the last 4 weeks, 5 weeks. I don't think the stock market's up because we're pricing out a downturn in the economy. If you look at leadership, it's been all growth all day. And that's lower rates, lower inflation fears. So why focus on claims? Because if we are going into recession, if we believe that you want to remain cautious on equities, it's going to be claims and also earnings that push the market back down. And so Tyler mentioned that hope cycle. And while there are a lot of things that are different today, this is part of the story that's never different, never with a capital N. Housing is always the first part of the economy to respond to higher interest rates. Employment's always the last. So everything the Fed has done this year and the big rise in long rates we have seen over the last 2 years, it's showing up in housing. It's showing up in some stocks, but it's not showing up in employment yet, and it will.